Welcome back, traders, to Trade KJD. Whether you're a seasoned pro or just getting started with day trading, you'll probably hear the term liquidity thrown around. But what exactly does it mean? And why is it so important for your success? In today's video, we'll deep dive into the concept of liquidity, why it's a game changer for day traders, and how you can leverage it to maximize profits and minimize risk. Stick around because by the end of this video, you'll have the tools to trade smarter and more confidently. Let's get started. Let's kick things off with the basics. What is liquidity? In simple terms, liquidity refers to how easily an asset can be bought or sold in the market without significantly affecting its price. A high liquid market has a lot of buyers and sellers actively trading, meaning you can execute trades quickly and at a fair price. For example, let's look at the stock market. Large cap stocks like Apple or Microsoft are considered highly liquid because they have a high trading volume. On the other hand, a small cap or penny stock might be less liquid, meaning fewer participants and wider spreads. But why does liquidity matter so much for day traders specifically? Two reasons. Speed and cost efficiency. When you're in and out of a trades multiple times a day, you can't afford delays or slippage due to the illiquidity. A liquid market ensures you can execute trades quickly, minimizing your risks. Now that we know what liquidity is, let's break it down into three components. At number one, we have volume. Well, this means volume refers to the total number of shares or contracts traded in a given period. A higher volume generally means better liquidity. For day traders, it's crucial to look at stocks or assets with high average daily volume to ensure smooth execution. And number two, we have bid, ask, spread. The bid price is what buyers are willing to pay, while the ask price is what sellers are asking for. The smaller the gap between these two, the more liquid the asset is. Wider spreads can eat into your profits or cause unexpected losses. And last but not least, market depth. This means market depth refers to the number of buy and sell orders at different price levels. It's an essential factor for avoiding slippage, especially when trading large positions. Together, these three elements define how easy and cost effective it is to trade an asset. Now let's talk about how liquidity impacts your trading strategy. Whether you're scalping, swing trading, or holding positions for a few hours, liquidity plays a pivotal role in your decision making. At number one, you have entry and exit efficiency. What do you mean by this? In a highly liquid market, you can enter and exit positions quickly without significant price movement. But in an illiquid market, your trades might push the price up or down, causing slippage and eating into your profits. At number two, we have risk management. This means high liquidity reduces your risk of being stuck in a position. If news breaks or the market turns against you, you want to know that you can exit without a major loss due to a lack of buyers or sellers. And last but not least, we have strategy selection. What I mean by this, liquidity also determines what strategies you can use. For example, scalping requires high liquidity to execute multiple trades quickly, while swing trading might allow for slightly lower liquidity. Understanding how liquidity impacts your trades will help you choose the right assets and strategies, ultimately improving your success rate. Also, you can identify liquidity above highs and below lows. By now, you're probably wondering, how do I measure liquidity? Don't worry, I've got you covered. Here are the top tools and indicators every trader should know. At number one, we have volume indicators. Volume is one of the easiest ways to gauge liquidity. Look for stocks with high average daily volume, ADV for short, on platforms like TradingView or Thinkorswim. Number 2, we have level 2 data. Level 2 market data shows the order book, including buy and sell orders at different price levels. It gives you insights into market depth and helps you anticipate price movements. Number 3, we have bid ask spread. Most trading platforms display the bid ask spread directly. Tight spreads are a good sign of liquidity, while wide spreads should raise a red flag. And last but not least, we have liquidity scanners. Some trading platforms have built-in liquidity scanners or heat maps. These tools can quickly identify the most liquid stocks or forex pairs for the day. By using these tools, you'll always know whether an asset is worth trading or better left alone. Even with all this knowledge, liquidity can still trap you if you're not careful. Let's go over a few common pitfalls and how to steer clear of them. At number 1, we have trading during low volume periods. What I mean by this, liquidity dries up during certain times, like pre-market, post-market, or lunch hours. Avoid trading during these periods unless you're prepared for wider spreads and higher risks. And at number 2, we have chasing liquid stocks for big moves. What I mean by this, sure, low volume stocks can have explosive moves, but they're also harder to trade effectively. Stick to liquid assets unless you have a clear plan. And last but not least, ignoring news events. Major news events can temporarily disrupt liquidity, causing wild price swings. Be cautious when trading around earnings releases or economic announcements. By being aware of these traps, you'll avoid unnecessary losses and improve your trading consistency. Alright traders, let's wrap it up. Today we covered what liquidity is and why it matters, the key components of liquidity, volume, bid, ask spread, and market depth, how liquidity impacts your trades, the tools you can use to measure liquidity, and finally, the common traps to avoid. Remember, liquidity is the backbone of day trading. By focusing on highly liquid assets and timing your trades effectively, you can reduce risks, lower costs, and improve your chances of success. If you found this video helpful, please hit the like button and subscribe for more trading tips. And don't forget to share your thoughts or questions in the comments below. I'd love to hear about your experiences with liquidity. Thanks for watching, and as always, happy trading.